In this video, we're going to be doing review exercise 9-1 that deals with issuing a notes payable. Anytime the company that is issuing the note, they're the one that's actually requesting the loan. So they tell us in review exercise 9-1 that Rescue Sequences LLC purchased inventory by issuing a $30,000 10% 60-day note on October 1st. And we need to prepare the journal entries for the company to record the purchase and payment, assuming it uses a perpetual inventory system and also a 360-day calendar fiscal year. So for this one, they are saying that we are issuing the note in order to purchase inventory. We can issue a note for one of three reasons: for the purchase of inventory, for a loan of cash, or to replace an existing accounts payable. Meaning, if we had an accounts payable with a company with credit terms net 30 and we couldn't pay them in 30 days, we might request an extension, and with that extension, the company would require us to issue a note. And most of the time, notes are going to have an interest rate associated with them. So let's journalize our issuing of our note and for the payment. So on October 1st, they said that we issued the note for the purchase of inventory. So we are getting inventory in the amount of $30,000, and we are signing a notes payable. A notes payable is very similar to an accounts payable, except that it is an actual legal document, and it's only good for the amount of days that's stated in the notes. In this case, it's only good for 60 days. We'll assume that we paid in the 60 days, which would be December 1st. We're going to eliminate our notes payable, and remember, our notes payable can only come off of our books at the value it went on to our books for. That's known as our face value. We also had to pay interest, so we have an interest expense here. In order to calculate interest, we have to take the face value of the note, multiply it by the interest rate, which in this case was 10%, but we need to multiply it by the amount of time that we had to pay back. Remember, all interest rates are stated in annual terms, and I'm obviously not going to pay a year's worth of interest if I only had 60 days. So we have to make sure that we're multiplying it by the amount of time that we had to pay it back. Again, this review exercise noted that it was using a 360-day fiscal year. That is pretty standard with all lending institutions. So that gives us a total of $500 in interest expense. And we pay off our loan by paying cash. And the total amount of cash, also known as the maturity value. The maturity value is the face value plus the interest owed on the due date of $30,500.